What's going on? You found these stocks? These are not dividend plays. These are what you call kind of dividend plus kind of plays, thinking of dividends maybe in other ways.
Yeah, what are you buying if you want dividends right now? Maybe you're buying utilities, right? You're thinking that the S&P 500 has a dividend yield of around 2%, and you're buying into these utilities, you're getting a yield of around 4% on the sector, so you're doing really well.
Wait 1 second, says Jack Hough.
There's
more.
Now everything's going to change.
There's more.
So, as you know, companies, when they want to return cash to shareholders, dividends are only one of their options. The other option is they can buy back some of their shares. When you do that, you decrease the share count, and in theory, at least.
Let's go. We're gonna have some visuals for you, Jack.
I like it.
So you can actually explain this. There we go. There's a dividend yield, 4.1%. I think we need the other bullet points there. Oh, stock issuance.
I like it. Yeah.
Yeah. Well, you take people
all
through it. Yeah,
fancy
we're going crazy here.
All right,
Total
so here we
payout.
go. So now when you subtract, what you want to do with the shares is you want to take the amount that they're buying back, and companies are also issuing shares, right? So you want to net those two figures out.
Some are issuing and some aren't.
And some are doing both at the same time. So the bottom line is, are they making my shares more valuable or less valuable? Are they reducing the share count or expanding it? In the case of utilities, they are net stock issuers.
Right, they're expanding the share count.
Right, so you really have a yield. You think you're getting 4%, you're really getting 3.5%. If you do that same math with the S&P 500 broadly, that 2% and change dividend yield really becomes over a 5% total yield.
That's because a lot of companies are buying back a lot of stock. Microsoft, for example. Microsoft has a huge share buyback program, as well as, by now, kind of a healthy dividend yield.
That's right. Now, there are two caveats here.
You're always focusing on the glass half empty.
I'm always throwing
throwing water on my
we have to add that repurchases, I think, are not quite as good as dividends, because dividends, first of all, it's a set rate. Companies tend to predict in advance what they're going to spend, and it's cash in the pocket. With repurchases, you need that stock price to stay stable or go higher to get your money's worth from them, and companies tend to change them year to year depending on how profitable they are. But there's also a benefit, which we won't spend too much time on, that you get under share buybacks. You kind of avoid taxes, which in the dividend yield you pay through the nose on the taxes. I'll just add that that's true, and I'll just add that I asked the gang at UBS to run a screen for me for companies that are consistently buying back a lot of stock on top of their dividend yields. They made a list. Companies that they also have buy recommendations on.
Give us a few names.
Just a couple names. Coca-Cola Enterprises, you get a 2.3% dividend yield there, but when you add in the repurchases, you're over 10%. BlackRock, you get a big dividend yield, 3.4%, but add in the repurchases, you're at close to 12%. So for some of these companies, the repurchases can make a big difference.
Yet, many investors, they just want those U.S. Treasuries. They don't care what you say, Jack Hough.
They'll pay any price for those things.
They don't hear what you're saying. Tell them that maybe they're making a mistake.
Well, if you buy 10-year Treasuries, if you have $1 million in savings, congratulations, your annual income is about $17,000 a year.
Right.
With your $1 million in savings.
And on an inflation-adjusted basis,
it's less than zero.
You're going to lose. It may be close to zero, but thereabouts.
Yeah, right. You're going to lose buying power.
Listen to Jack Hough, ladies and gentlemen.